This week in economics on the 3rd of June 2017 from WBRN Radio in Boston and on the Bostonred Network. This is Numbers Man here, and we have a report, very interesting report. We'll be talking about jobs, manufacturing. We'll take a brief look at DJ Trump's infrastructure plan that he plans to kick off next week in Ohio, Kentucky, various other places involving placing airports in a non-profit corporation. There are several countries that have done this, but none of them, those countries are on the size of the U.S., i.e. The U.K. and Canada. We'll look at that plan and initial reaction of Congress to it. And we'll go first, Lee, to the market PMIs to set this up, and then we'll look at the jobs report for May. But first, market and their PMIs to sort of get an overview of what is actually going on out here across the American landscape. The market people put these PMIs out. We'll start with the global manufacturing PMI. It was dated on the 1st of June. This is JP Morgan's global manufacturing PMI and ISH Market in association with others. The growth of global manufacturing slipped to a 6-month low in May. The rate of expansion in global manufacturing sector eased to a 6-month low in May and was signaled by the JP Morgan Global PMI, a composite index produced by JP Morgan and IHS Market in association with ISM, posting 52.6, down slightly from 52.7 in April, still above the magical of 51.4. Developing nations had tended to outperform emerging nations in markets in April. Growth across emerging nations slowed to a pace only marginally above the stagnation mark. The developed market PMI continues to signal solid and steady expansion among its largest nations. Covered by the survey, the U.S. PMI slipped to an 8-month low, and the China PMI dropped below the critical 50 no change mark at for the first time in 11 months. The UK PMI remains close to April's 3-month high. Rates of improvement strengthened in the Eurozone, 6-month high. Japan, 3-month high. Worldwide manufacturing production rose for the 55th consecutive month in April, underpinning by a solid increase in work received. However, the rate of expansion in output moderated further as it weakest to its weakest since last November. The growth of new business studied at April's 3-month low. The upturn remains broad-based by sub-sectors. Similarly, rates of output expansion were seen across consumer, intermediate, and investment good producers. There was a greater variation between the trend in new orders. The investment goods sector saw the strongest increase, with the pace of expansion the second fastest in almost 3 years. Growth also accelerated in intermediate goods producers, but eased to an 11-month low for consumer goods. Companies maintain 1 year 1 year ahead of the outlook for production volume in April. Meanwhile, rising levels of work in hand suggested current capacity was still being tested. The combination of The combination of large order optimist outlook and rising backlog work encouraged a further job expansion in April. Employment rose for 9 months in a row and a pace above average for that sequel. Price pressures continue to ease in May. This is highlighted by the rate of increase in both input costs and output costs. Changes easing to an 8-month low. Both price and measures also tended to slightly sharpen increase for developing nations on the average than in emerging markets. And let me see if we missed anything here. Commenting on it, David Hansley, he's Director of Global Economic Coordination there. The global manufacturing sector continues to expand in May, achieving further steady growth. The underlying dynamics of the survey, such as fuller order book and rising employment and positive business sentiment, also bode well for future performance of manufacturing. So manufacturing has come back somewhat. The global PMI in May at 52, it was 52.7 in April. Output at 53.6 in April, 53.5. You can see a little drop here. New orders were unchanged at 53.6. Employment at 51.6 in April, 51.5 in May. Input prices at 59 and down to 55.1. Output prices at 52.9 and 51.6. You can see a slower rate there, and future output at 63.8 in April and 63.5 positive, lesser extent there. So now let's skip over here to the Eurozone manufacturing PMI. This is the final data. Eurozone employment rises at a 20-year survey record pace. The final Eurozone manufacturing PMI at 57. In May, the flash 57. April was 56.7. Strong growth of production and new business support. Survey record creations. Germany stayed atop the PMI growth ratings. The ongoing expansion of the Eurozone manufacturing sector gave us further momentum in May. Growth in output and new orders accelerated to the best seen for around 6 years to underpin strong job creation, strongest in 20 years of the survey. The final ISH market Eurozone manufacturing PMI rose to a 73-month high of 57 in May, up from 56.7 in April. The PMI signaled expansion in each of the past 47 months. Improved business conditions were signaled in 7 of the 8 nations by the survey. The growth acceleration was mainly driven by strong expansion in Germany. And let's see. Staffing levels rose at quicker rates in Germany, 6-year high. Italy below the October 69 series. Spain fastest in 19 years. Ireland 2-year pace. Australia 2-month high. Slows increase were registered in France. The Netherlands and Greece reported job growth for the first time in 6 months. Companies reported improved inflows of new business from both domestic and export markets, with the rate of expansion in new export orders hitting a 73-month high. The sole exception, of course, being Greece. The standout performance in Germany, where the rate of expansion rose to a 7-month high. The improved performance of the Eurozone manufacturing sector and expectation of brighter conditions in the future led companies to forecast increased production in 1 year time. Business optimism remains close to January's record high despite easing to a 5-month low. The latest survey points to continual pressure on capacity. During April, backlog of work at manufacturers rose for the 25th consecutive month, with rates of accumulation the highest since April of 2011. Supplier capacity was under strain, as highlighted in the steep lengthening of vendors' time for over 6 years. The supply chain factors also contributed to further increases in average input costs in May, continuing a trend towards the seller's market. Developing for many items, however, there were signs that price inflation pressures were easing from recent highs, and highlighted a slower rate of increase in both input costs, 6-month low, and output costs at a 4-month low. And let's get the rest. Pace in Germany topped the growth for the third consecutive month. Austria and the Netherlands were also showed rates of manufacturing expansion. Greece was the only monitoring company to see a contraction. Eurozone manufacturing production rose to its fastest pace since April 2000. We already reported that. From Dr. Chris Williamson, the business economist at IHS Markit. The Eurozone upturn is developing a deeper roots as factories enjoy a summer growth span. Demand for goods is growing at the steepest rate for 6 years, encouraging manufacturers to step up production and take on extra staff at a rate not previously seen in a 2-decade histories of PMI. The fact that upturn is being accomplished by such a strong job growth sends a signal that increased numbers of companies are moving away from a focus on cost cutting and towards investment in expansion, and understanding that the elevated levels of business optimism seen across the region. The record hiring adds to a sense that the upturn is looking more and more robust as each month goes by. Germany is leading the upturn. Solid upturns are being recorded in other countries such as the Netherlands, Austria, Spain, Italy, and Ireland, while France is lagging behind, is nonetheless enjoying its best quarter for 6 years. The market easing and input cost inflation during April will meanwhile be a welcome news to policymakers eager to see a sign of recent uplift in consumer prices. Now, these are some of the nations here. Germany, of course, is at a 73-month high at 59.9, Austria at 58, the Netherlands at 57.8, Ireland at 55.9. That's a 22-month high for them. Netherlands is a 4-month low. Austria is at a 2-month low. Ireland is at a 22-month high at 55.9. Spain a 4-month high at 55.4. And Italy at 55.1. That's a 3-month low for them. And France at a 2-month low. They're at 53.8. And now we head to the U.S. All is not rosy in the U.S. The Eurozone, moderate improvement in overall business conditions. PMI slips to 8-month low in May. New orders have rise has slowed since September 2016. U.S. manufacturing companies indicate an upturn in business conditions during May, but the latest survey reveals a further loss of momentum from the peak at the beginning of 2017. The softening overall improvement in manufacturing conditions reflects moderation in new business growth, the weakest for 8 months, alongside relatively subdued increase in output and employment. May's data also points toward more cautious inventory policies, falling at the fastest pace since August of 2016. At 52.7 in May, down a fraction from 52.8. U.S. respondents note that the resilient business confidence optimism about the general economy and outlook has helped to underpin staff recruitment in May. Meanwhile, input price inflation eased sharply from April 2.5-year peak, and moreover, and let me just get the manufacturer's purchasing index was above 50, no change there, but signaled the weakest improvement in business conditions since September. The latest reading points to a further growth slowdown from 52-week high recorded in June. That was at 55. May's data indicates manufacturing output increased for 12 months running. The rate of expansion picked up slightly from April, 7-month low, but remains relatively modest. Survey respondents noted that the subdued new business growth and more cautious inventory pricing has added as a brake on production goods were accomplished at a slower pace been seen in the start of 2000 accumulated. Meanwhile, pre-production inventories dropped for the second month running. New orders increased again in May, although at the rate of expansion was the least marked recorded since September 2016. The latest survey points to a decline in backlog work for the first time since May of 2016. Manufacturing firms noted that a sustained staff hiring has helped to alleviate capacity pressures. Payroll numbers increased at a modest rate in April, although the latest rise was much softer than the 18-month peak in December. From, again, Dr. Chris Williamson here, manufacturing momentum continues to ebb in May down to its weakest since just the beginning of the presidential election. Manufacturing output, order books, and employment all grew at only modest rates as sluggish sales prompted firms to scale back hiring. Export sales remain especially lackluster, happening in part as the relatively strong dollar. The survey also brought signs of companies becoming more cautious about holding inventory. Factories' raw material prices rose at a sharply reduced rate, which should be at least help take pressure off of profit margins. Also feed through to weaker pressure on consumer inflation. So what this translates out to, the Fed may be very reluctant to raise interest rates as much as possible, but we do expect in June for those interest rates to be to move forward. Now to job growth here, and we'll go over it. We'll actually just go with first, and we'll go back to Reuters and look at it. The employment situation. This is May of 2017. Total non-farm employment increased by 138,000 in May. The unemployment rate was a little changed at 4.3. The rate of employment 4.3%. The number of unemployed persons at 6.9 million, little change. In May, since January, the number of the unemployment rate has declined by 0.5%, and the number of unemployed persons has decreased by 774,000. Amongst the major groups, the unemployment rate for Europeans edged down to 3.7%. In May, the jobless rate for African Americans 7.5%, for Asians 3.6%, for Latinos 5.2%, as well as for adult men at 3.8%, adult women at 4%, teenagers at 14.3%. Little change there. Amongst the unemployed, the number of job losers and persons who completed temporary jobs declined by 211,000 to 3.3 million. The number of long-term unemployed persons was essentially unchanged there at 1.7 million, accounted for 24% of the unemployed. The labor force participation rate, we hear much about that, declined by 0.2%, posted at 62.7% in May, and has no clear trend has shown no clear trend over the past 12 months. The employment participation ratio index down to 60% in May. The number of persons employed part-time for economic reasons as voluntary part-time workers was little changed at 5.2 million. These individuals would prefer full-time work if they can find it. For May, 1.5 million persons were marginally attached to the workforce, down by 238,000 from a year earlier. So more people are not marginally attached, looking for a job, and sometimes in a 12-month period. Amongst the marginally attached, there were 355,000 discouraged workers in May, down by 183,000 from a year earlier. The remaining 1.1 million persons marginally attached to the labor force in May had not searched. Total non-farm payroll employment increased by 138,000, compared with an average of 181,000 over the past 12 months. The job gains occurred in healthcare and mining. Employment in healthcare rose by 24,000. Medical centers added 7,000 jobs over the month. Employment in ambulatory healthcare services continued to trend up, 13,000 there. Job growth in healthcare has averaged 22,000 a month thus far in 2017, compared with an average of 32,000 in 2016. Mining added 7,000 jobs. Employment in mining has risen by 47,000 since reaching its recent low point in October 2016. In May, employment in professional business services continued to trend up, 38,000 there. The industry has added an average of 46,000 per month thus far this year, and it's in line with job gains in 2016. Employment in food services, drinking places also continued to trend up. In April, you would expect that 30,000 has grown by 267,000 over the past 12 months. Employment in other major industries, including construction, manufacturing, wholesale trade, retail trade, transportation, warehousing, information, financial activities, and government, showed a little change. The average work week for all workers on private non-farm payroll was unchanged at 34.4 in May. Manufacturing in the manufacturing work week also was at 40.7 temps, while overtime edged up at one tenth to 3.3 hours. The average work week for production and non-supervisory workers edged down 1/10 to 33.6. In May, the average hourly earning for all workers rose by 4 cents to $26.22 over the year. The average hourly earning has risen 63 cents, or 2.5%. In April, the average hourly earning private sector production workers increased 3 cents to $22. The change is the total non-farm payroll employment for March was revised down from 78,000 to just 50,000. And the change for April was revised down from 211,000 to 174,000. With these revisions, employment gains in March and April combined were 66,000 less there. And this time of year, you're going to have some fluctuation, no doubt about that, so you can stay tuned for that when doing your various evaluations during this period. Now let's go to the Reuters. Job growth slowed. The rate of unemployment at 13.4%. This is from the Reuters job group in May, and employment gains in the prior 2 months were not as strong as previously reported. That is not unusual. Are they cooking the numbers here? Probably not, because we've seen this on the various administrations over the past 20 years. The labor market gains have still been sufficient for the Federal Reserve to raise interest rates, and that'll be at its June 13-14 policy meeting. The economy needs to add 75 to 100,000. I would say that would be north of 100,000 per month to keep up with growth of working age populations. And if it is barely keeping up, but to get the slack out, you need around 300,000 plus. Details of the employment report were weak. The unemployment rate fell 0.1%. Was because 439 people dropped out, and this is since 2001. And we won't go to hourly here. Economists also believe that companies might be holding off on hiring. That would possibly be there, waiting on perhaps some tax cuts at infrastructure. We'll go to the infrastructure part. Politically uncertainty in Washington is another factor holding back the job market. That is from a fellow we used to work with, Sue Wong. Sue, the economist at the University of California, Channel Outlet in the Camarlo. The probability that any Trump stimulus would become reality has decreased significantly in the past few weeks. He at one time was an economist with Wells and Northwest Bank, etc. Very good economist there. Economists forecasted payroll increase of 180,000 last month. The unemployment rate. Well, the unemployment rate is something we're not looking at as much, because basically it has been in 4.3, 4.4, 4.5 attempts there. Modest payroll gains that could temper expectations of sharp acceleration in economic growth in the second quarter, after gross domestic product at a tempered 1.2%. Well, the second quarter is a very, very tricky quarter. Consumer spending picked up in April. The second report on Friday showed the trade deficit widening at 5.2, 47.6 million. The Fed in Atlanta is forecasting GDP at 3.4% in the second quarter. That is a little bit high. There was a good news, broad measure of unemployment there. Anyway, working part-time because I can't find it, fell 2 tenths. Well, 8.4%, the lowest since November of 2007. Word went over the labor force participation rate. The volatile 16 to 24 age group accounted for much of the drop in the participation rate last month, suggesting a rebound is likely. Well, also you have the summer jobs. We haven't talked about summer jobs this year at all. Manufacturing employment fell by 1,000 last month as payroll in the automotive sector dropped 1,500. Declining sales. Ford Motor Company was in the mix there. It plans to cut 14,000 salaried workers in North America. Now, this is what is actually happening out here in other sectors. In the mining sector in places like Wyoming, they have picked up several hundred workers doing effectively what's called open pit mining. Construction payrolls rose 11,000 last month after decreasing 1,000 in April. Retail employment, of course, declining 6,100 for the fourth straight month. And department stores are shedding 3,700 jobs. This is like Macy's, J.C. Penney, Abercrombie Finch, and so forth and so on. Amazon hired 2,900 workers last month. Government decreased. Now, this is a very important figure here in the President DJ Trump administration. Decreased by 9,000 last month with state and local governments accounting for all of the decrease. Now, state and local governments, when the national government does that, they also go down. Walmart is taunting its tech investment. They're trying to go more tech. They've been touring around. Then Walmart has to do more for workers despite the 2.7 investment in worker training and the wage hikes in 2015 and 2007 to $10 an hour. $10 an hour is menial. We're pushing it for $15 an hour, which is a pittance now. The average at about $26, $22 an hour. Investment in technology has delivered a 63% rise in a quarterly online sales, up from 29% growth in the fourth quarter and 20% there. So in other words, they haven't invested. They outshined the Target Corporation and other apparel retailers. And we won't go into stockholders meeting there at Walmart, but you can bet it was a lot of people there. And let's see what else we have here. Well, we'll go to the Guardian here. There's a couple of notes to note on the number. The ADP, now the ADP is an accounting service, announced that employers had added 253,000 jobs in May, well above the 180 economists had been expecting. Now, this is from Mark Zanni. He is the chief economist at Moody's Analytics. Said job growth is rousing. The current pace of job growth is nearly 3 times the rate necessary to absorb growth in the labor force. Increased businesses' number one challenge will be a shortage of workers, according to him. But according to the Bureau of Labor Statistics, fell way short. We've already reported that. But the fractional political landscape may derail the federal plan. The White House is preparing for a fight over raising the federal debt limit and approving government funding. If not resolved, will rock the economy, global markets, etc. The latest report again highlights the uneven nature of the economic recovery. And we talked about that for various groups. For Europeans, 3.7 in May, while the rate is 7.5 for African Americans, 5.2 for Latinos. From Mark Hamrick at bankrate.com, he's senior analyst there, economic analyst. While the Federal Reserve might not be dissuaded from raising interest rates this month's meeting, the job numbers might make the debate at least more vibrant. The lack of many of more sustainable inflation also argues against further trajectory of aggressive rate hikes. Well, whether or not it's vigorous, the argument is there. It's a very tenuous, and the reason that it is so tenuous is the summer months are very, very hard to predict. You've not heard very much about summer work. That used to be a big proposition. Students out, high schoolers, college students finding summer employment. We see very little emphasis on that and youth employment as a whole, which is not covered very well. In future reports, we'll try to get to exactly where that is in the scenario. But now let's do the numbers. I had another attack in London. Unfortunate situation there. Several people were killed. Now, businesses criticize Trump's climate move. This is a very big factor there. Some that did criticize him. And someplace here, here we are. But some companies are sticking around. Tesla is not one of those. Mr. Elon Musk left the so-called White House Advisory Council, which he was smart to do. Now, companies like Walmart are hanging on there. J.P. Morgan Chase, IBM said their CEOs remain there. Some of these companies, it matters. Some of them it don't. Walmart is, of course, in the mix. J.P. Morgan Chase hadn't heard much from the banking sector. IBM, they're in a transitional period. So whether or not they're there or not doesn't really matter that much. Walmart, the largest retailer, said that, of course, its executive will remain there. You'd expect that, and so did IBM, but they are supportive of the Paris Accord. Now, some of these companies have a lot to look at. This is from Reuters. Incidentally, General Electric, who is on the Manufacturing Council, said that he was disappointed with the decision, added industry must now lead and not depend on government. This is Jeffrey Mint. From the AFL-CIO, Richard Trunka, who is also on the Manufacturing Council, called withdrawal of failure of American leadership. A union spokesman said that Trunka intends to remain on the council to serve as a voice for working people. From Boeing, who will also remain there, the Trump administration pushed back against criticism. Well, that's a waste of time. On CNBC, this is Cohen. He is the National Economic Council Director. Said the move was part of the administration's effort to boost economic growth and help companies by increasing demand for American goods. Will not do that. What is happening here? You basically are seeing a trade-off by one sector to another sector. But the problem is this. When you talk about the mining sector, i.e. petroleum production, strip mining, etc., that serves relatively small areas, in other words, where you see the improvements. In the Appalachian parts of Ohio, Kentucky, you'll see some job improvements there in places like Wyoming, Gillette, Wyoming, etc. But those are outliners in the sense that they're not major economic groups. And it's very tenuous. BlackRock, the chief executive there, Mr. Fink, said Thursday he would continue to serve on the council. General Motors also remain on the council. Uber Technologies quit the Business Advisory Council after the inaugural. So in other words, you're seeing a little bit of a trend here, but the newer companies are moving away from the council, whereas some of the old hat operators are still sticking around there. Let's go to the markets now as we start to conclude our report this week. So we've covered PMIs, and PMIs basically reflect what is happening, particularly in the U.S. and in the Eurozone. Eurozone is in much better shape. That's centered around the Paris Accord. All of those nations are following the Paris Accord, which is a very interesting situation in the months to come. We're talking about July and August. Very, very important months here in the U.S. And we usually do have lackluster growth because people on holidays, schedules, etc. Normally, the automotive plants retool during those months, so you'll have some temporary layoffs. But now you're seeing realignment in many, many industries you did not see. JCPenney, for example, is closing on more stores later this month and, of course, in July. And workers will be made redundant there. So those are things you'll start to see. If 500 jobs are added, you lose 1,000, you have not gained anything at all. And the airport modernization scheme, we'll get to that after we do the numbers here. Nonetheless, the Global 30, this was on a Friday at 90. The FTSE All Share at 1.45. In Amsterdam, they were down 2.9. In Frankfurt, the DAX was at 158.20. In Paris, they were at 17.75. Oh, excuse me, that is in Brussels. In Paris, they were 27.74. And in Madrid, they were at 24.9, all on Friday. In Zurich, at 19.04. In Moscow on Friday, at 5.15. In Johannesburg, they were down in the negative 294.82. In Bombay, at 130.7 on Friday. In Karachi, they were down 225.51. In Lahore, they were also down 45.11 in the negative. And in Colombo, also down 4.61 in the negative. In Tehran on Wednesday, 1.80. In Sydney, 48.60 on Friday. The Nikkei at 317.25 on Friday. The Hang Seng in Hong Kong at 114.83. And in Shanghai, 2.92. In New York, 62.11. And the Nasdaq at 58.97. The Merc, that's the commodities market out in the Midway City of Chicago, at 9.01. In San Pablo, they were down 1,046.17, and also it's on Monday, and in Mexico they were also down 648.2. A quick look at the commodities. Being a very speculative situation, we'll look at where energy stands. Brent crude futures were down 51 cents at $50.12. Quite a drop since last week. That was on Friday, and on Thursday the spot was up 11 cents at 50.23. West Texas Intermediate crude was down 53 cents at $47.83. That shows the tenuous situation in the energy sector. But T-Boone Picken is still jumping for joy about $15 barrel oil, which is effectively at 1970s prices, about the same. Cocoa futures down $23. Gold was down on the Forex, $5.20 at $1,260.95. Dubai gold futures were down $2.80 at $1,270.20. Silver was up 6 cents at $17.19. On to the Eurex light futures. Cocoa was down $17 there. Robusta coffee was down $3. And the Bloomberg Commodity Index was down 14.14 at 82.33 or $82.33. It was down 14 cents. And this will do it for us. There was one other thing we wanted to get into, was DJ Trump from Bloomberg. Infrastructure proposal, and we're just briefly on it. That will be next week. The proposal will be released on Monday. It'll be in the Rose Garden, but all will not be rosy. Has proposed $200 billion in federal spending on targeted federal investments, part of a $1 trillion program for rural areas, etc. Incentives to spur state, local, and private entities to generate more of their own revenue for projects. Not going to happen. The Schuster plan is basically what it is, and it went nowhere. Air traffic control plan will be based largely on legislation introduced in 2016 by Bill Schuster. He's a Republican from Pennsylvania. Next Gen or not, is already years into the Federal Aviation Administration upgrade known as Next Gen. The efficiency improvement it promised can be done more efficiently outside of direct government control, says backers of the White House plan, anecdotal. Most large airlines, some former high-level FAA managers favor the privatization plan, was opposed by Democratic lawmakers, private aviation groups. They fear the transition would be a setback to the introduction of new technology. Now, about 60 countries, including Canada and the UK, have similar programs, but they are very, very small plans. On June 7th, DJ Trump will go to Cincinnati. That is in the Appalachian part of Ohio, Kentucky there, and talk about the plan. He'll host mayors at the White House on the 8th for waste of time. The plan to finish the week at the Department of Transportation offices in Washington. Approval that could take, roads and rail projects, that approvals that could take 10 years should be done in 2 years or less. Well, speeding up so-called shovel-ready jobs, that's just one of the things. Anyway, we added this up there. For those in business, make next week a productive one. For the consumer, keep your eye on the prize. There are sales out there in the retail sector because more and more retail stores are closing. Have a good weekend, everyone. We'll talk to you next week from WBRN Radio in Boston on the Bostonred Network. This has been This Week in Economics on the 3rd of June.